In this video, I'm going to share 5 Singapore REITs that pay quarterly dividends. These REITs could help you build a steady passive income stream in 2024. Let's get into it. Hey friends, welcome back to the channel. I'm Iggy here, and if you're new, I've been covering stocks, finance, CPF, and wealth building topics for the past 5 years. The investing Iguana was ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. Our channel has produced over 500 videos with more than 250,000 watch hours as of September 2024. The current REIT landscape real estate investment trusts, REITs, have shown remarkable strength in 2024, marking their 5th consecutive month of positive returns, with a 3.009% gain in September and an impressive 9.61% return year to date. This performance has outpaced major market indices, including the NASDAQ, S&P 500, and Dow Jones Industrial Average. The sector's resilience is particularly noteworthy in the current economic climate, with shopping center REITs leading the charge with a 10.62% return. The REIT market shows interesting patterns across different market capitalizations. Mid-cap REITs have emerged as the strongest performers with a 5.01% return, while large-cap REITs gained 3.41%. Small-cap REITs have also shown positive momentum with a 2.59% increase. However, micro-cap REITs have struggled, showing a slight decline of 0.42%. This performance gap highlights the current market preference for larger, more established property portfolios. Property type performance varies significantly across the REIT sector. Data centers and advertising REITs have been the standout performers in 2024, with returns exceeding 34%. However, some sectors face challenges, particularly single-family housing REITs, which declined by 2.80%. The sector's overall health is reflected in its pricing, with most REITs trading at around 15.5 times their projected 2024 funds from operations, FFO. This valuation metric suggests that despite recent gains, many REITs still offer reasonable value for long-term investors seeking both income and growth potential. First REIT, healthcare focus. First REIT has established itself as a significant player in the Asian healthcare property sector, managing a diverse portfolio worth $114 billion spread across 3 key markets. While the REIT faces some short-term challenges, its fundamental business model remains robust, focusing on essential healthcare infrastructure that tends to be resilient during economic downturns. The trust currently maintains a 100% occupancy rate across its 32 properties, demonstrating the strong demand for healthcare facilities in these growing Asian markets. Recent financial results show some pressure points, with rental income declining 5.3% in the first 9 months of 2024, primarily due to currency fluctuations affecting their Japanese and Indonesian properties. However, when measured in local currencies, their Indonesian properties actually saw a 4.4% growth in revenue, while their Singapore nursing homes achieved a 2% increase. The REIT's financial position appears stable with a gearing ratio of 39.3% and 86% of its borrowings hedged at fixed rates, providing protection against interest rate volatility. Looking ahead, First REIT's strategy appears promising, with its long-weighted average lease expiry of 10.8 years providing predictable income streams. The trust is currently trading at an attractive 16% discount to its net asset value, offering a forward distribution yield of 9.3%. Their growth strategy, dubbed First REIT 2.0, includes plans to diversify into developed markets and optimize their portfolio through strategic divestments of non-core assets. This approach could help reduce their exposure to currency risks while maintaining their focus on the growing healthcare sector in Asia. MapleTree Industrial Trust, Tech and Industry. MapleTree Industrial Trust, MIT, has built an impressive portfolio in the industrial and data center sector, with its assets strategically spread across 3 major markets. Their property holdings, valued at $8.9 billion, include 83 properties in Singapore, 56 in North America, and 1 recently acquired data center in Japan. The geographic distribution shows a balanced approach, with Singapore representing 48.5% of assets, North America at 46.6%, and Japan at 4.9%. The trust's performance in the second quarter of fiscal year 2025 demonstrates robust growth, with revenue climbing to $181.4 million, a 4.2% increase from the previous year. This growth was driven by strong leasing activity and the successful integration of their new Osaka data center acquisition. The trust's net property income also showed healthy growth at $134.5 million, up 4.6% year-on-year. Their improved portfolio occupancy rate of 92.9%, up from 91.9% in the previous quarter, reflects strong demand for their properties, particularly in North America, where new lease commitments have strengthened their position. MIT maintains a conservative financial approach with an aggregate leverage of 39.1% and an average borrowing cost of 3.2%. Their prudent risk management is evident in their debt structure, with 80.4% of borrowings fixed at stable rates. This financial discipline has enabled them to increase their quarterly distribution per unit to 0.0337, representing a 1.5% year-on-year growth. The trust's strategy of recycling capital through strategic divestments, such as the Tanglin Halt cluster sale, while reinvesting in high-growth sectors like data centers, positions them well for sustained growth in the evolving industrial real estate market. MapleTree Logistics Trust, Regional Logistics Play. MapleTree Logistics Trust continues to demonstrate resilience in the Asia-Pacific logistics sector, managing a substantial portfolio of 188 properties spread across 9 key markets. Their assets span strategically important locations, including Singapore, China, Japan, Australia, and emerging markets like Vietnam and India. While their total portfolio value holds steady at $13.4 billion, recent financial results reveal both challenges and opportunities. The trust's latest quarterly performance reflects the complex regional economic environment. Revenue declined by 1.8% to $183.3 million, primarily due to softer performance in China and currency headwinds from the weakening Japanese yen and Chinese yuan against the Singapore dollar. Higher borrowing costs have also impacted their bottom line, with interest expenses increasing by 8.2% compared to the previous year. However, stronger performances in Singapore and Australia, along with contributions from recent acquisitions, have helped offset some of these challenges. Despite these headwinds, MLT's operational metrics tell a more optimistic story. The trust has improved its portfolio occupancy rate to 96.0%, showing strong tenant demand across their properties. Lease renewal rates remain positive in most markets, achieving a 3.6% increase when excluding China. The trust continues to execute its portfolio rejuvenation strategy, completing several strategic divestments at an average premium of 15% above valuation, while simultaneously expanding in high-growth markets like Vietnam and Malaysia. Their well-distributed debt maturity profile and ongoing capital management efforts, maintaining a leverage ratio of 40.2%, position them to navigate through current market conditions while pursuing growth opportunities. MapleTree Pan-Asia Commercial Trust, Office and Retail Mix. MapleTree Pan-Asia Commercial Trust, MPACT, stands as a major player in Asia's commercial real estate sector, with a diverse portfolio of 18 properties valued at $16.5 billion as of September 2024. Their assets span 5 key Asian markets, with Singapore forming the backbone of their portfolio at 55% of total asset value. While recent financial results show some headwinds, with gross revenue declining 6.1% to $225.6 million in the second quarter of FY 24-25, this decrease primarily reflects the strategic divestment of MapleTree Anson in July 2024 rather than underlying performance issues. The trust's Singapore portfolio has demonstrated particular resilience, with gross revenue actually increasing by 0.7% year-on-year when excluding the MapleTree Anson divestment. Their flagship asset, Vivo City, continues to perform robustly despite ongoing enhancement initiatives. The portfolio maintains a healthy committed occupancy rate of 90.3%, with rental uplifts ranging from 2.5% at MapleTree Business City to an impressive 17.3% at Vivo City. On the financial management front, MPACT has taken proactive steps to strengthen its position in a high interest rate environment. The trust reduced its borrowings from $6.8 billion to $6.1 billion, using proceeds from the MapleTree Anson divestment, improving its aggregate leverage ratio from 40.5% to 38.4%. Their debt portfolio is well structured with 77.1% fixed rate debt, providing stability against interest rate fluctuations. The trust maintains ample financial flexibility with approximately $1.0 billion in cash and undrawn committed facilities, ensuring strong liquidity for future opportunities. Suntec REIT, Singapore's mixed-use giant. Suntec REIT's property portfolio tells a story of contrasting performance between its local and international assets in late 2024. In Singapore, their properties continue to show remarkable strength, with office spaces nearly fully occupied at 99.1% and retail spaces performing exceptionally well at 98.3% occupancy. The Suntec City Mall has been particularly successful, improving its occupancy to 98.4%, while One Raffles Quay maintains a robust 98.7% occupancy rate. However, the REIT's overall financial performance has faced headwinds, with revenue declining by 4.6% and net property income dropping by 5.7% to $79.8 million in the third quarter. This decline stems primarily from challenges in their international portfolio, particularly at 55 Curry Street in Adelaide and the Minster Building in London. The Australian properties show mixed results with a 90.6% occupancy rate, while UK properties maintain a solid 95.3% occupancy despite recent slight declines. The financial impact has been significant, with distributable income falling by 11.2% to $46.2 million, leading to a reduced distribution per unit of $0.0158. Despite these challenges, there are positive signs in the form of strong rental reversions across all locations, particularly in Singapore, where office rentals achieved a 10.8% increase and retail spaces saw an impressive 20.9% uplift. The REIT maintains a stable financial position with an aggregate leverage of 42.3% and has hedged 61% of its borrowings against interest rate fluctuations, demonstrating prudent capital management in a challenging market environment. My take on these REITs. Singapore REITs present diverse investment opportunities across different real estate sectors, each with unique market dynamics and growth potential. First REIT, focused on healthcare properties across Asia, offers stability through long-term leases, with established healthcare operators and benefits from aging population trends. Its portfolio of hospitals and nursing homes, particularly in Singapore, Japan, and Indonesia, provides steady rental income despite some currency headwinds. MapleTree Industrial Trust, MIT, and MapleTree Logistics Trust, MLT, capitalize on the growing industrial and logistics sectors. MIT's strategic shift toward data centers and high-tech industrial spaces has proven timely, with its portfolio occupancy improving to 92.9% and showing positive rental reversions. The trust's recent expansion into data centers in Japan demonstrates its focus on high-growth sectors. MLT benefits from the e-commerce boom and supply chain reorganization, with its modern warehouse facilities attracting quality tenants across Asia Pacific. MPACT, formerly MapleTree Pan Asia Commercial Trust, and Suntec REIT represent the commercial sector, offering exposure to both office and retail recovery. While office occupancy rates have faced pressure from hybrid work trends, prime locations in Singapore's central business district continue to command strong rents. For income-focused investors, these REITs typically distribute dividends quarterly, providing regular passive income. However, successful REIT investing requires looking beyond dividend yields to examine fundamental factors like occupancy trends, weighted average lease expiry, WAL, debt costs, and gearing levels. Currently, most Singapore REITs maintain healthy gearing ratios around 35–40%, though rising interest rates have impacted borrowing costs. If you enjoyed this 2025 REIT outlook, you'll want to check out my video on Singapore property market hidden opportunities for 2025. It complements this analysis perfectly with insights into the broader real estate.